starting early makes it easier and makes it less expensive to plan for a comfortable future.
I've just seen so many times where, somebody had all this coverage and then they left the job, and then the new company either doesn't offer comparable coverage, maybe it's a lesser coverage, or it's something that's more expensive, or you run into this insurability issue.
I think it's really important, to do two things. It's to talk with, your advisor to figure out financially what makes sense. You don't want to be underinsured. You don't want to be overinsured. You want to kind of get in that sweet spot. But also you want to make sure, if you're perfectly healthy, you're just going to basically be shopping for rates. And that can vary by pennies. It can vary by thousands of dollars. Many people in this age bracket don't understand that life insurance can be part of the retirement plan, especially when their supplemental retirement savings could fall short.
All right, we've got another edition of the Financial Playbook lined up for you with your host, Jim Sumter. I'm RJ Malik, producer of this podcast. And Jim, we've got, of course, we always talk about the 6 puzzle piece playbook. You've got a guest, and what will you be discussing today on this podcast and how it ties into the playbook?
Absolutely. So RJ, great to see you today. So we are going to do a part 2 from our previous episode. And we have still with us Eileen Shovlin, who is the Director of Business Development for Crump Life Insurance Company. And, Eileen shared her story on the previous podcast. So if you haven't heard that, absolutely go back and listen to that, because she has an amazing story and how all of her puzzle pieces fit together in her financial plan. Today we're gonna continue with the theme of insurance, although I'm sure we'll touch on a lot of the puzzle pieces, but we're going to continue with the theme of insurance and sort of get into a little bit of how logistically to make this work and at different stages in life and things like that. So Eileen, welcome back. To part 2 here. Now, I asked you an icebreaker question in the first episode. You're gonna get a different question in this episode. And continuing with the theme of loving music. Okay. If you are driving on a 4-hour drive, so I don't know how far it is from Pennsylvania to Vermont, where you have 2 homes, but let's say you're on the road and you can only listen to one band or singer or group, but you get their entire repertoire. Who are you listening to?
Okay. So don't let this formal business, attire kind of influence this one, but
I get it.
It's going to be the Grateful Dead.
Oh, wow. Okay.
And let's be honest, with the Dead, a 4-hour could be like 3 songs, right? So,
that is very true.
Thrown in there, right?
That is very true.
It's immersive. It's unpredictable. There's always something new to hear, even if you've listened to the song 100 times. So if I'm stuck in traffic, I want to be dancing in my car to a 20-minute Uncle John's Band.
Yeah. Okay. Hey, you know what? I get it. Now mine would be the Eagles. But, and we may do the 7, 8, 10, 12-minute version of Hotel California, depending on which live show they had. So
they were both at the Sphere. So they're both iconic,
Now, did you see the Grateful Dead at the Sphere?
It is a big regret. I did not. I kind of have a lot of FOMO from it, but
okay.
No. Did you?
I did see the Eagles at the Sphere. Yes, I did. Absolutely. I've seen a lot of concerts in my, years. I've never seen one like that. Unbelievable venue, unbelievable band. Probably the last time I'll see them.
Yeah.
It was amazing. Absolutely amazing.
If the Dead do it again, I'm there. My planning has me covered. I'll pay what it costs to go do it.
Yeah, I understand. I get it. Okay. Remind us briefly of your background, and then we're going to jump into this, this practice of insurance and financial planning.
Well, thank you so much for having me on, first of all. For the past 30 years, I've been in the financial planning, financial services world. For the first 17, I was in what I'll call an insurance and capital markets adjacent type of business. And then I transitioned my career around 40 or so to being in the insurance brokerage business. So Crump Life Insurance works with advisors like you. We work with, wirehouse people. We work with career people. career carrier people. And we basically provide them solutions and products that fit the needs that their clients have. So they come to us, they ask us kind of like, hey, here's the situation my client's in. Can you help me craft an insurance plan that would make sense and would fit the puzzle, would fit the puzzle with the right piece?
Mm-hmm. Okay. And that's how you and I met several years ago. Is I had some questions about some very specific cases, and I reached out to you, and we just started chatting and talking. And I think we had like a 15 or minutes so time slot, and I really think it was like an hour and a half, 2 hours later we got off the phone.
Yeah.
And then we met in person, and then we've had coffee. And last time I
And
was
then
in
you were in my
Philadelphia.
backyard in Villanova. So
Yeah, exactly. I was up doing, up at Villanova. We met for breakfast. So we have developed this relationship over the course of time, and every time we talk, I learned something. And so, one of the reasons I reached out to you in the beginning is because I had a couple of different cases, and I talk about it. I think I'm going to go back to, I believe it was episode 3 or 4 of this podcast, where I talked about different stages in financial planning and their wealth accumulation, which is going to be from the time you're in school up to about age 45, and then wealth preservation, which is about age 45 to 65. Honestly, that's where both of us are right now, is in that stage. And then wealth distribution is where we hope to be one day, which would be 65 or older, or in that retired, where you're starting to use some of your money. And as we talk about insurance, what I'd like for you to do is kind of walk us through each of those stages, and maybe where some nuggets of things that we might want to be looking at from an insurance perspective. And then I'll throw one more twist just while I'm asking the question here. Is there a difference between a couple or an individual male or an individual female? We've talked a lot on this podcast about this generational transfer of wealth, and, from this generation to the next generation, and that females are going to control, I believe it's 67% of the net worth in this country by the year 2030. I mean, that's huge. And so, is there a change, and is there a philosophy around insurance in these various stages and among the genders, which is not really something we've ever really focused on before, but I think it's becoming a conversation that we're starting to have. So I probably gave you, I don't know, a couple hours worth of material in that one question. So yeah, so I'm going to let you go, and then we'll chat as we go on here.
Well, if you listen to my story, you'll know that I started planning kind of not intentionally, but because I had to, right? I had a wake-up call when I was younger. So when we talk about that wealth accumulation stage, that up to like 45, that magic number, my perspective on that is it's starting early makes it easier and makes it less expensive to plan for a comfortable future, right? So if you can quickly identify your goals and your long-term needs with an advisor like you can understand early on how much life insurance might be right for you, right? Because the concept of life insurance, like, let's be real, nobody wants it, right? Like, if you didn't have to buy car insurance, would you? No, you buy it because you have to, right? And when you think about your life and you're thinking you're a 27-year-old woman, right, who has a career and has everything kind of going for her, you don't think you're ever going to die, right? You can't die. And if you're a single mom, you're living forever. And the reality is, this is just like, we don't call that shot, right? So, that's part of where the education about life insurance comes in. And when you look at like the millennial group, and I pulled some stats out, I think that they're important. I don't love to preach by stats, but I think they're important for a framing reference.
Right.
75% of millennials today say that increasing or beginning to save long-term is a high priority as they look ahead. They're seeing what's going on with parents, like, our generation, and they're scared. And many people in this age bracket don't understand that life insurance can be part of the retirement plan, especially when their supplemental retirement savings could fall short. And the other thing, there was a study done by Corbridge, which is an insurance carrier, and they said that the majority of millennials are concerned about the availability of Social Security, And about half of them say getting or increasing life insurance coverage has become somewhat or much more important than it has in the past year. And that was done this year. So, we do see a shift and we do see concerns. But what's the barrier? And the barrier is education. And I think one of those misconceptions is, and we'll talk about it in a little bit, but like they'll get group insurance through work and they're like, well, I have it. But, it's not always portable. And that means you could take it with you if you leave the company or you get fired, right? And if you do take it with you, sometimes it's prohibitively expensive to take with you, even though you didn't pay for it when you were there. To take it with you is really expensive. And if you're no longer insurable, when you leave that job with the group insurance, you can't get your own insurance. So I think the cost is a misconception. And I know we see all the kind of like, it's less than a cup of coffee a day, but it kind of is, and so the cost is generally less than what most people think the cost of life insurance is. So for a healthy 30-year-old, and this is from a LIMRA study, which is a trade organization in insurance. They did this in 2024. And they basically looked at a healthy, non-smoking 30-year-old, and they looked at just $250,000, which actually isn't much when you break it down, but we'll use that as a reference point. And if they bought if they rent insurance for 20 years for $250,000, it's 55 cents a day. And if you look at like what eating out every day costs, what entertainment, cell phones, transportation, when you look at the daily cost of that we find is like, you have to have it. And then you look at 55 cents a day for life insurance, it really puts it in a good perspective. And I think we need to be telling that story more.
Yeah. So let me ask you this, because just a couple of follow-ups. When you talk about insurability, okay, because we all think we're always invincible. I think everybody probably does until something happens or until they're not. And what does it really mean to be insurable? And maybe relate it back to your story of when you were 27 and had the car accident, you were still insurable, but what if? And what does that really mean and why is it important?
Yeah. So what they do is, there's two pieces to insurance, and that's your financial side. So they look at what you can have on your life, what makes sense given your assets and your needs. And then there's a medical underwriting, right? Because basically they're playing a game. Right? It's like, how long are you going to pay premium? How long are you going to live? So they look at your life expectancy. And so if they look at the average life expectancy of a 27-year-old, it's somewhere probably for a woman around 84, 83, something like that. Maybe it's a little bit less post-COVID. But then they're going to say, okay, if she pays premium for that amount of time, and understanding some people won't always pay their premium, like some people will drop their policies, but they look at that and they say, okay, if you have a healthy person that's going to live to 83, this is what we're going to charge them. But let's say you get cancer. Let's say you're a smoker. Let's say you have sleep apnea and you don't take care of it. Let's say you're very overweight or horizontally challenged. Now you're actually going to impact your longevity. So instead of living to 84, you might now live to 75. And so that means the claim would have to pay out sooner and they're going to charge you more. So any life events, whether it's an accident or an illness or a sickness, all of that's going to impact what we call insurability. And it will either render you uninsurable, where you actually can't even get life insurance, or it's going to become prohibitively more expensive.
Right. Okay. So let me ask you this, because you work for Crump, which is a broker. Crump is not an insurance company that really issues policies, but rather you have a lot of other companies that you represent that do issue policies. Does every insurance company look at those things the same? And is it important to quote unquote shop around when you're looking for that? Because we hear, these advertisements on TV, or we see something on TikTok, or we see, so-and-so, I can, whatever. Are they all the same or are they different?
Yeah, we wouldn't be in business, quite frankly.
Okay.
So I think, I'm not going to say any way is wrong, but I think, one carrier is going to say, we really don't like cancer, and or they may have had a lot of claims in the past 10 years for people because of Alzheimer's or something like that. So different carriers have different exposures to risk. So that's going to affect, how they look at, what they want to insure during different times. Sometimes they're like, okay, there's been some changes in medical science. Now we're going to change the way we look at this. So even, we'll bring up controversial marijuana smoking. There's some carriers that if you disclose it and it's for, medical reasons that aren't like morbidity purposes, like you're using, they might be fine with it, where another carrier says, oh no, that's awful, you're going to be double the rates. So I think it's really important, to do two things. It's to talk with, your advisor to figure out financially what makes sense. You don't want to be underinsured. You don't want to be overinsured. You want to kind of get in that sweet spot. But also you want to make sure, like, if you're perfectly healthy, you're just going to basically be shopping for rates. And that can vary by pennies. It can vary by thousands of dollars, depending on what you're looking at. But, if you're unhealthy, really important to really get, dig in, disclose, be very upfront and honest, because if you're disclosing it, it's a little bit more acceptable. And then take the shopping approach to see what carrier might have the appetite for your situation.
Well, okay. That's, and really, quite honestly, that's the reason you and I even had our very first conversation, is because I had a specific case. And rather than going to a specific carrier, I said, okay, here's my set of circumstances. Here's my fact pattern. Here's what the goal and the objective is.
And even products.
What works. Yeah.
Some carriers only carry whole life. Some carriers only sell term. Some carriers sell variety of products and disability and long-term care. So, some carriers sell life insurance policies that have long-term care built into them, even though they're life insurance policies. So, all of those things require, I think, a lot higher level of sensitivity to not just like log on to, buymylifeinsurance.com, put it in the bot and, spit it out. I think it's really important for people who have a financial planner to like make sure that's integrated into the conversation.
Right. So Eileen, you mentioned long-term care. So, as I start working with a client that's in this wealth preservation phase, so what I call the second phase, so ages, say 45 to 65, what starts happening is we start thinking about, okay, what if I needed I had a long-term care event down the road? And the reason that a lot of times we think about it is because something happened to grandma, something happened to mom, something happened to my cousin's aunt, something happened to my neighbor's friend, things like that. There's generally a trigger event that makes us think about our own lives. And it really is in this phase that I see this starting to happen a lot. So my question is, if we've set up our insurance in the wealth accumulation phase one way, are we always going to stay with that strategy? Or as we get into this wealth preservation, could there be a shift in the way that we think about coverages and the types of coverages and what our goals are?
Such a great question. And I think it does depend on what kind of life insurance or what kind of insurance you put in place.
Okay.
Because things like term aren't as flexible, right? I mean, they're kind of rent it. You can sometimes convert it. And again, you want to shop. And some of the things even with term insurance, like, is it convertible? What is it convertible to? What does the product look like? Because there are some carriers that have really good cheap term. But if you ever wanted to convert it to a permanent product because you wanted it to be flexible, you change your mind, you want it long term, you're stuck. And then you got to go out and get re-examined. And if you've had a health change, there's an issue. So I think it depends, Jim, on what type of insurance like you put together. If you listen to my story, I had a couple different policies that I layered. One I got rid of, and then one I kind of looked at and said, okay, this is flexible. I have some movement here. I have cash. What do I want to do with that? So, that 45 to 65-year-old age, as you mentioned, it's like retirement's around the corner-ish. And retirement's now lasting longer, right, than it used to. So ensuring your retirement is sound, using life insurance that can be used for life's expenses, even the unexpected expenses, you can choose plans with features that give you confidence and flexibility, and no matter what life throws at you. So, when you look at this demographic, 72% of like the Generation X, will use that term, say they fear running out of money more than death. And that was also like a Corebridge carrier study. So they fear running out of money more than they fear death. And as you very eloquently pointed out, this is the sandwich generation. So there's a lot of focus, not only for caring for children and getting them through college and out of the house, but you're caring for parents. And it creates a lot of anxiety and fear. And so many people in this demographic still cover costs for their adult children. Like I said, I got mine off the payroll, but they're financially supporting kids, they're financially supporting aging parents. And some of them are even taking out additional debt to support this financial commitment. So by having this insurance coverage conversation with an advisor and including your family and your plans, you can get a lot of peace of mind. So for me personally, I then took this, what I used as kind of a savings vehicle for college as a supplement to other financial planning. I took this, if I die too soon vehicle, if I ever got into trouble financially, I could take a loan. I took that and I said, okay, I'm in a different financial picture than I was at 27 now that I'm 47, right? And so I was able to then think about, okay, I shared with you before the show, my parents just moved and we moved them from our 40-year family house into a 55 and older 1-story house. My dad's now 84. I finally got to talk to their financial advisor. Anybody listening, make sure your kids get to meet your financial advisor because it would make us feel so much better. But I got entree to there and I got a picture of that. And I'm like, I don't want my child to ever go through this. I want him to know today that mom is okay. I'm financially taken care of. He will have to supervise my care, but he's not going to have to provide my care or fund my care. So that became a big thing for me because I was going through those life events. And also, in our last episode, I mentioned, like, I now want, as I work, I want to feel really good about what I leave behind between where I do volunteering and then where I'm going to leave my money. And so I've also then parlayed some of this to set up an estate plan so that if and when I should say not if, but when I leave my body, I am going to be leaving money to charities and to causes that I feel really strongly about. And that insurance helps me still leave stuff for my family, but then take some of my taxable assets and leave them to a charity that won't have to pay the tax on them. And I feel really good now going to work every day. I know that like there's multiple things that I'm doing to kind of achieve what my goals are.
Right. I love everything that you've said. Let me ask this. I touched on this in the beginning of the question, and I talked about gender. And what I see a lot of times, we had Jillian Berry, who is our Strong Her Money ambassador for our firm on, I guess, 3 or 4 episodes. She did a double episode with us as well. And we talked a lot about women and the female perspective. And I think a lot of times what happens is, females, I'm making a very general statement. Females in general are more emotional than men. And a lot of times when we begin to have this conversation about this sandwich generation, a lot of times it's the female that brings it up because they're the ones who feel the burden to make sure that things happen. Is that you're in this world? Is that what you see? And does that change between these various stages of life?
There's this awesome book. Harley Gordon is like kind of a national figure with long-term care. And he's put really cool, I'll call storytelling together about it. And he kind of uses this analogy. He has a book called Changing the Conversation. And he says, when you think about now, granted, there are a lot of women policemen and there's a lot of women firefighters, but let's go to like the male firefighter. They're going in that burning building. They're coming out alive. They have no doubt. They're going to go in. They're going to save the people. They're going to be the hero. They're coming out. Their wives are sitting at home or at work thinking to themselves, what happens if he gets trapped in that building and never comes home? Right. So there's a different mentality of like risk and reward or, what we look at as like consequences. I just think by our very nature. Now, mind you, I tend to be a little bit more masculine in my thinking. I ran a household. I'm a single mom, a solo mom. I have a little bit more of that and I'm in this business. But yet, for me, most of what I've done in my planning have been emotional decisions, even though I have this logic. I want guarantees. I don't like to I risk in my portfolio because clearly I'm younger and I understand I've been educated by my planner. But, when it comes to stuff like, income and emergency funds and what happens to my family, if something happens to me, like I get very emotional about that. So I do think, not to say men can't, but usually it's the woman in the room that's gonna talk to. So when you and I have talked, your participation in Strong Her Money is just so inspiring to me. It's something that I've taken on. I've done a lot of speaking nationally about planning for women, and I just think it's really important to understand, hey, what keeps you up at night, and talk, and I'm sure you do this. Talk to the female by herself. Talk to the male by themselves and then bring them in together and see where things line up or don't line up to make sure that financial plan speaks to both of them. And I think, life insurance, long-term care insurance, disability insurance, it's a lot of insurances. But when you think about the peace of mind and what they actually ultimately do for the financial plan, I think women really get it.
Hi everyone, I'm Cassidy, the second C in CMC Financial. So Dad sometimes gets on a roll with this podcast and might forget to remind you about a few things. 1, don't forget to like and share this podcast and leave a review. 2, follow CMC Financial on all of the socials, Facebook, Instagram, and LinkedIn. And 3, go check out the website at cmcfp.com. Okay, back to my dad. He's probably still talking.
Yeah, I would agree. As we move to this last phase, or the what I call the wealth distribution phase, the one where we're kind of retired now, we're starting to need some of our money. Are we seeing a shift in the types of insurance products that are recommended or used or utilized in that phase? And maybe talk to us about that a little bit.
Yeah, I mean, and again, it depends on where you are financially, right? It depends on
Right.
where your wealth is. One of the biggest questions, no matter who it is, and I've even seen very wealthy people say this, is like, do I have enough set aside to be financially independent when I retire, in the way that I want to retire, in the lifestyle I want? And so, this demographic can ensure their retirement uses life insurance that can be used for life expenses in addition to legacy. So I think it's a question of, now we're kind of moving towards the mortality years. So it's like, what kind of legacy, what kind of values do you want to pass down, right? I've seen very wealthy families be like, I want, to set up a family foundation. I want this cause to be extended in my family. I don't want my kids to not work, so I want to make sure this is done, or it could just be as simple as, I want my grandkids to go to college, right? So you start thinking legacy more. So that's where we talk a little bit more about permanent insurance with guarantees. We talk about tax planning, and, oftentimes you're getting into trust planning and things like that, where insurance is a really powerful thing, both charitably and for legacy and tax purposes. So obviously in this age group, they're thinking about, when they can retire, what will their income sources be, and how will their expenses change over time? And also understanding people are working longer, and that a 65-year-old in today's day and age, again, when we talk about longevity or mortality, they can probably expect to live another 19 years. And that was from a national vital statistic report in April of this year. So a 65-year-old has to plan for at least 19 years on average for their income. So when they look at their income sources and see their retirement and their Social Security, sometimes the numbers don't add up to what they need, thinking about this extended longevity. And as you just said, about 70% chance that somebody turning 65 today will need some type of extended care services, or what we'll call long-term care services. So 70% of people will need that. And that's according to the U.S. Department of Health and Human Services on a paper they did back in January. So that's a pretty staggering statistic. And knowing that, hey, I have my portfolio and that's great. But again, it's the education to say, if I don't have to use my money, to pay the whole piece of it, and I can do planning early, and I can share that risk with an insurance company, it can make a lot of sense. The other thing that's kind of scary is about 42% of Americans are at risk for developing dementia after age 55. And the median expense today, according to a Genworth cost of care study taken last year, it's about $5,000 a month now and I'm not talking like the Cadillac of care. We're talking like, decent care. And so that's a huge piece of the puzzle. When you think about puzzle pieces, a huge piece of the puzzle that, again, sometimes people are like, my kids will take care of me. Men often say, and I'll say this as a joke, but it's serious. Men say, my wife is my long-term care plan, right? She's younger. She's going to live longer. She's got, she's the CFO of our household as it is. She'll take care of things, but then what happens to her? Right. And then we bring that woman into the conversation. So again, I think you can reduce stress and enjoy flexibility using insurance protection. And you don't have to die to use it and supplement and protect your assets. And, you want to avoid being financially dependent on others. And there's a whole wide range of flexible policy features and options that you can do that can address a lot of retirement concerns. So I think, again, the traditional view of like my group insurance and it pays when I die, that's kind of an outdated concept. And the fact of like, paying if you die too soon, live too long, get sick along the way, all of those things are part of a full risk management strategy. And I think whether you're using term or permanent, or, you use long-term care insurance, we didn't talk about disability insurance, but if you're younger in that younger demographic, making sure you're protecting your paycheck, because oftentimes your group disability, it doesn't cover enough, and it's often taxable, right? I mean, they have to pay tax on that money. So, considering some of these as kind of an add-on or a layering, I think is a really smart financial move.
So, Eileen, a couple of things that I'll tell you before we begin to wrap up. We're going to have a whole series on disability insurance. That is an animal of its own, and so we're gonna talk about that. But one thing that you've mentioned, and I kind of want to begin to wrap with this question, is group insurance. I see so many times, whether I'm preparing a tax return and I see it on the W-2, that they're, that they've got their company and they say, well, all that kind of stuff's taken care of at work. Or, I've got my benefits and I do that. But it seems like so many people are leaving this company, moving to this company. They're hoping they get benefits here. They're hoping they get benefits there, but they may or may not be insurable, which we talked about, and that's certainly a risk. What do we see in this whole group concept versus individually owned concept, and really why is that important, and what do you see in the world?
Yeah. So, I mean, I think it's a big perk. My company, I'm fortunate enough to have some group insurance. And when I looked at it when I was younger, and I think it's like, it can be a couple multiples of salary with a cap, right? And if you're paid commissions or bonuses and things like that, how does that factor into the disability calculation? So I would come to somebody like you to say, hey, Jim,
Right.
How much do I need each month? And you have to come up with that budget. You need to come up with that number of like, what do I need for, like, they call it the MUG for, what is it? Mortgage, utilities, and groceries, and then
Right.
other things, right? And then look at what that formula is, because everybody has a different formula for what that group benefit looks like. And more times than not, it's not going to replace your cash flow. So, that's the first piece, is like to do that analysis, to really understand what it is you have, and then be conscious of the fact that they could drop that benefit. Like, I've been in a company where they did drop my benefits and it wasn't as nice as the benefits before. They could have a layoff. And then all of a sudden you're like leaving the company and they're like, oh, and this is going to cost you, $10,000 a year. And you're like, what? So I think, understanding that, like, it doesn't travel with you if you leave the company, that you probably won't be with that company for your lifetime. That's a little bit more of a unicorn scenario now, right? And just understanding that it's a nice to have, but it's not a piece of your financial foundational planning. To own it and control it and have the optionality and the flexibility that we've been talking about throughout this conversation, you really have to have that as a personally owned policy. But again, you enter the group into the formula, but understanding that that's not a part of your permanent plan.
Well, and you've talked a couple of times about, what is an insurance company? They look at, they want to underwrite you financially, but then they also want to underwrite you, insurability. And so, when you're talking about what am I going to, it's difficult to make $30,000 a year and go out and get a $5 million life insurance policy. It's like, wait a minute, there's a disconnect there somewhere. And so those are the types of things that they're looking at. Well, if you have these coverages at work, but then you want to go try to get this individual coverage, we have to factor that in a lot of times, because the insurance company wants to know. They want to know what do you have? What else do you have? What do you have the ability to do? Things like that. And I've just seen so many times where, somebody had all this coverage and then they left the job, and then the new company either doesn't offer comparable coverage, maybe it's a lesser coverage, or it's something that's more expensive, or you run into this insurability issue.
Yeah, not to be a downer on this, but there was a case that I worked on very early in my career, and it stuck with me all of my 30 years in this business. And it was a gentleman who was a lawyer, and he was in his 30s. He was a personal friend of the advisor that sold him, or that advised him, and he had group term.
Mm-hmm.
And he got Parkinson's in his 30s. And so he had to leave his job, and he left his benefits, and he had 3 kids. And he could not get any insurance. And so he still had debt. He still had a lot of things. And so financial planner said, from now on is my crusade that every single working person that I advise at least has some personally owned insurance, because I can't help him, because there's nothing I can do now. He needs the insurance when he can't get it. And so again, it's a downer, but it's reality, right? And I was lucky enough to be able to walk away and then be able to secure it and button up my plan, because I hadn't done it before. And a lot of people can't.
Right. Let me ask you this, and this will be our last question, and I'll dovetail it with a little bit of my story. And this is my question around having insurance on your children. And so, when Carson passed away, at 17 years old, we had one insurance policy on him, and it was a $10,000 children's rider on a group policy. And I looked at that, and while we were very blessed to have that, it didn't cover everything. And so, we were out of pocket there. But then with Madison and Cassidy, I immediately turned around and bought an insurance policy, even though they were both minors at the time. And I bought an insurance policy where they're the insured. I was the owner. I'm paying the premium. They're the insured. At some point, I will let them start picking up the premiums. But right now, kind of like you and your son with the AAA, I'm making sure that I'm paying those premiums right now. And I did that for this simple reason. You never know. What if? And so, candidly, we have a $100,000 policy on both of the girls. Again, they're the insured. I'm the owner. And, that at some point we'll transfer ownership to them. Have you seen that? What's your opinion on doing that? Because I've heard varying ones.
I mean, I really think it's again, these are all individual choices. It's based on like your philosophies and your relationship with money. I think it's a gift of love. I mean, we've seen a lot of grandparents do this. And again, I'm a little old school. Like I came from not a lot, and, my savings philosophy was molded by that. So, it's setting your kids, your grandkids up for a discipline. And so again, it's kind of one of those things where you're passing on your values to your kids. So if they die too soon, it's there to help the family kind of not have to worry about that piece of it. They can focus on the important piece.
Right.
If they live long, right, now they have this asset, and they're learning by your example about different ways to save and the importance of planning and the importance of thinking about the what ifs, and that we're not superheroes that are going to live forever. So I think it's a gift of love, and I think it's a gift of your values. So again, it really depends on the person and their financial status and kind of their philosophy. But I when I hear, that kind of planning being done, it makes me feel really good, because it really is that gift that you love your family.
Right. Well, I appreciate you saying that. And Eileen, I can't thank you enough for the time in these last couple of episodes. This is a piece of the puzzle that is not the most glamorous. It's not the most fun. Nobody wants to go buy insurance because we all feel like we don't want to do it. But guess what? We need it. And what I hope that we've expressed through these last couple of episodes is the importance that it is not a cookie cutter. Not everybody fits into a mold. It is very specific to you, to your needs, to your goals, to your objectives. And I think, with your stories and your expertise, you've helped us to see that. So I greatly appreciate the time. If someone had a question for you or just kind of wanted to follow you, you have some great content on LinkedIn and things like that. Is LinkedIn the best way for someone to do that?
Yeah, definitely. If you just put Eileen Shovlin, I think there's a couple of us out there, but you'll know which one is me by the pictures. And again, I work for Crump Life Insurance Services. So definitely check out my LinkedIn, send me a message, or contact Jim because I'm just a phone call away for Jim too.
Absolutely. And if you follow me, then I follow her, so you can get to it from there. And we'll also put it into the show notes. And then RJ, I guess if someone wanted to get in touch with us, as always, our website is a great way, cmcfp.com. And then my direct number is 205-510-9074. Or we are on all the socials, LinkedIn, Facebook, Instagram, and our YouTube channel. So that is all we have on this puzzle piece for these last couple of episodes.
Excellent. Thank you, Eileen and Jim. That was fascinating to listen to. And thank you for listening to the Financial Puzzle Playbook podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for Jim and everyone at the Financial Puzzle Playbook, I'm RJ Malik, and we'll see you at the next podcast.